FRK 3 to 1, a continuation of earnings per share. We will continue from the previous video, number 3, which related to lecture number 2 done by Mrs. Pollock. Earnings per share is a very important indicator of how well that share has done in the market, and it is used very widely to compare one share with another of another company. Now, Mrs. Pollock did the previous recording with you on earnings, and this is the basis of earnings per share. You must know how the earnings is calculated, what earnings we are using, as you can see there, earnings after we have deducted the preference share portion. And then, of course, the other one, the weighted average number of shares. Further, she went into detail with the earnings, how earnings is calculated. She also went into detail of weighted average number of shares, the WANOS. You can again refer back to that video if you haven't done that so yet. At this stage, I would suggest that you pause your video and go and have a look at illustrative example number 1, which is filed at the back of your notes handouts, or you will also find that on ClickUp, of course. So pause the recording, go and have a look at that illustrative example number 1, which is a very basic example at this stage. Fine. Now that you've come back after you've looked at illustrative example number 1, my suggestion would be also go keep your notes together or close by when we do this section. As you can see there, notes on page number 4, the so-called problem areas, and this is what we will be dealing with in the next few slides. Problem areas, preference dividends. Preference dividends. We get cumulative and non-cumulative preference dividends. Now, as we said previously, if a question states nothing, you assume that they are cumulative. Otherwise, we will tell you if they are non-cumulative. Now, when you have cumulative preference shares, you must take them into account in your earnings calculation, irrespective whether they were paid or declared or not. So, the cumulative preference dividend for that specific year will be calculated, and that is the item that will be deducted from your earnings for the year to be able to determine your earnings for EPS. On the other hand, the non-cumulative, only when they are paid or declared will you take them into account in the current year. So if they have not been paid, you ignore them. If in the current year, 2 or 3 years non-cumulative preference dividend was paid, then you will take that full amount into account in your deduction from the earnings. And this is then what we will utilize. So there you have the problem area, preference dividends. The following item, losses and taxation. The earnings amount is the profit or loss for the year, and therefore it is the after-tax amount. So when you go and look at, if you think about your statement of profit or loss, your earnings or your profit for the year is after tax, and that is what we take into account. Now, losses. Prepare a loss per share if the company made a loss. The same method as we did with the EPS itself. So in this case, you will say, instead of saying EPS, earnings per share for the year, you will say loss per share for the year. Everything else stays the same. The comparatives amounts, restate your comparative amounts if there was a correction of errors or if there was a change in accounting policy. Now, as you've done in FRK 311, there you had correction of errors, and what did we do? We had to adjust the error in the current year, and then we had to restate the comparatives with the correct amount. The same with change in accounting policy. Now, these two adjustments are straight to earnings. But you also have adjustment which goes against the calculation of your WANOS. So your capitalization share issue, what happens there? If you have a capitalization issue, it means that you held, let's say, 100 shares, and for every 2 shares you held, you will issue another share. So you will now have 100 plus 50. Those shares were issued without or for no value. And for that reason, you have to adjust the comparatives on the same pro rata principle. The second item there, a rights issue at less than fair value. Now here you have two elements. You have the element that was paid for, and then the other element, which we call the bonus element, which was not paid for. So a combination of value and for no value. We will have an example later on. Share split or share consolidation. A share split is very similar to share capitalization. Share consolidation, on the other hand, is again, you have 100 shares, but now you say for every 2 that you hold, we will make it 1 share. So then you, after this consolidation, only have 50 shares. Again, the comparatives must be adjusted, otherwise you cannot compare the two. And then the final one there, reduction of capital, where the number of shares have been affected. Restatement of basic earnings per share. We are still on the topic of restatement and comparative amounts. At this point, I will want to refer you again to page number 6 of your notes, handouts, and number 8 specifically, restatement of basic earnings per share. Keep this handy while we go through the slides. So there you have it. Issue of ordinary shares without a corresponding increase in resources. In other words, as we said, you have a split, a share split, or a capitalization issue or something like that. You do not weight the number of shares in the current year. So you will make that capitalization issue or share split as if it happened at the end of the year, but in full. You will make it in full on that specific number of shares. But what you have to do is you will have to go and restate the previous year, the earnings. And to do that, you're actually going to adjust the comparative amount of shares that was issued. So there's the examples as we saw on the previous slides as well. So let's look at specific items. Those were all issued at no value. Right, a share split. There's no effect on the net asset value of the company, but it increases the number of shares that was issued, and therefore it decreases the average value per that share. So as you can see that example, if you had 100 shares worth 100 rands, you now have 200 shares and they are worth 50 rands each. So in total, you still have the same amount or the same value. 100 times 100 is 10,000. 200 times 50 is 10,000. So you still have the same total value, but per share the value is now different. And that is the reason why you will actually have to now adjust your comparatives. The effect on the EPS, recalculate the EPS of the previous year to ensure comparability. Very important. Let's look at the second one. Share consolidations. In this case, the opposite of what we just saw. This reduces the number of shares issued and increases the value per share. This usually happens when shares are traded at a very, very low or small value, and sometimes what we call penny stocks. So we will consolidate our shares into 1 or 2 shares. Again, the effect on the EPS, recalculate the earnings per share of the previous year, and the major issue is you are going to recalculate the number of shares in issue. So you will do a pro rata adjustment for the prior year. Again, we will look at our examples later on. Capitalization and the bonus issue. Shares issued to existing shareholders in relation to the existing number of shares for no consideration. For example, you have 1,000 shares in issue and you tell the guys, listen, for every share that you hold, we're going to give you another share. So now you have 2,000 shares in issue, but no money transferred. You just gave more shares. So therefore, The value of the company stays the same, but the per share value now decreases. Usually that will be done against retained earnings. Number of shares increases, and therefore the earnings per share or dividend per share will decrease. Again, you do the adjustment against the shares of the prior year in a pro rata manner. Continuation. Comparatives amount are restated. Why? Firstly, for comparability, the capital had already been invested in previous period and in the form of reserves. So those reserves has now just been turned into capital or shares. And as we said, therefore all previous years must be adjusted. At this point, illustrative example number 2 in your notes, go to that. Please do that example. Pause the video here and do that example now. Dividend per share. Now, dividend per share is actually under IAS 1 and not IAS 33 as EPS, but we will deal with it here. Most important rule, whatever the number of dividends that are in issue, those are the actual number of dividends on which you will base your dividend per share. On the date that the dividend was declared, you will not wait or average it out. When that dividend is declared, there is a specific number of shares in issue, and those are the number of shares over which that dividend will be divided to get your dividend per share. There is one exception. That is, if you had a capitalization issue during the year, your prior year will have to be adjusted. So you use the adjusted number of shares for the previous year's dividend per share. Please look at class example number 1 in this regard. We will refer back to that later. Then let's have a look at the disclosure. Basic earnings per share and diluted earnings per share, which we will also deal with later, for each class of ordinary share is disclosed on the face of the statement of profit or loss and other comprehensive income with equal importance. In other words, your EPS, basic EPS, diluted EPS, equal importance. The one mustn't be more prominent than the other. And then dividend per share is disclosed on the face of the statement of changes in equity. Why do you think the difference between the two? Firstly, EPS, as it says, earnings per share, so it relates to the earnings, statement of profit or loss. Dividend per share, it relates to the shares and the dividends per that share, statement of changes in equity. Right, thank you for this one. Please go and do class example number 1 now. We will also put that up on ClickUp later. You can continue with that at this point. We will put up a video.